All right, welcome back to Pietros Maneos Finance. I actually didn't plan on doing another video today. I plan to spend the rest of the afternoon engrossed in the book that I'm holding here, right here, which is The Most Important Thing, Uncommon Sense for the Thoughtful Investor. It's by Howard Marks. Howard Marks is a very successful investor, multi-billionaire. His company, I believe, is Oak Tree Capital. 10 pages in, but I have to say I'm really disappointed. Essentially, I've found two glaring errors on the first two pages. So the first one here is not on the introduction. I believe it's on like literally page one. And he says here, and investing can't be reduced to an algorithm and turned over to a computer. So, yeah, that's just to me wrong, blatantly wrong. I'm not sure if he's not familiar with Jim Simmons and Rentech, if he hasn't read the book, The Man Who Solved the Market, how Jim Simmons launched the quant revolution. The Medallion Fund has had returns of 70% a year. Sometimes people say 40. So, so it's just a bizarre statement to discount the success of quant funds and beyond just Jim Simmons and Robert Mercer's Rentech. There are others who have had tremendous success with signal-based, with deep analysis of data. Now, for most people, there maybe he's saying most people aren't going to be Renaissance technology, but and also the other thing is, reduced to an algorithm. If you were to replace algorithm with formula, I mean, even a value fundamental investor who he mentions here, Joel Greenblatt, magic formula has outperformed the market. So I found that it's trendy amongst high level investors to dismiss algorithms, formulas, and software. And he would use the term probably first level thinking. He would view that type of thought or that type of process as first level, not really deep second level thinking. But the data is the data. So if a formula or an algorithm is outperforming, and it's outperforming over a long period of time, versus someone who's doing deep thinking or looking at formula and making their decisions based on data, but their own decisions, well, there's there. So that's just an interesting statement there. So, okay. So then on the next page, he says here, at bottom, it's a matter of what you're trying to accomplish. Anyone can achieve average investment performance. Just invest in an index fund that buys a little of everything. That will give you what is known as, quote, market returns, end quote, merely matching what the market does. But successful investors want more. They want to beat the market. So I will certainly agree with those last two sentences. That those who are engaged in actively investing for themselves or putting money in actively managed funds are seeking alpha, right? I mean, that's otherwise they would just invest in the index. The thing I would quibble with here is, and it's not my opinion on this. It's just the data. Is when Jack Bogle at Vanguard released the index fund in 1976, it was mocked as un-American, as, why would you want to settle for average? I think one of the competitors of Vanguard said something, would you want an average dentist or an average surgeon? And so, but the thing that has borne out over time is by buying indexes, you're not settling for average. You're settling for market returns, which are quite above active management. The large bet that Warren Buffett made, with any hedge fund over a period, I don't know if it was 5 years or 10 years, you can just Google that, find that information out very quickly. Warren Buffett, hedge fund bet. The index won. The index beat the assembled hedge funds that he assembled because of the tyranny of fees that the 2 and 20 model. So that's just a blatant misstatement that you're settling for average. I mean, I would think he would know this. That's why I'm just like kind of blown away, because he's so well respected. Warren Buffett has touted him and others, and he just sort of plays the role of the cerebral college professor. And so that's just a bizarre statement, knowing that when you're buying indexes, you're not settling for average. You are going to beat, and there's figures you can go and pull the data. J.L. Collins has written about it, as well as Jack Bogle. You could pull out any, that book, Simple Path to Wealth, or any of Jack Bogle's book, or do a little bit of Google researching on just the percentage over time of or how much indexes beat actively managed funds. So it's a lot less over a year, over 3 years, over 5 years. But then when you start getting out 10, 12, 15, 20 years, the percentage that indexes beat active funds is quite overwhelming. So just a little disappointed. I'm going to get back to reading, though. I'm on page 10. It's a shorter book. It's 180 pages. So I could probably finish it out today. But just that quick little aside on Howard Marks, and just kind of a little bit in shock. So anyways, ciao.